The One Big Beautiful Bill and 2026 Premium Tax Credits. Hi, it's financial planner Sean Mullaney. Let's discuss. So I'm seeing this all over the internet, right? We're all worried about 2026 premium tax credits and oh no, one big beautiful bill. It didn't do anything to change it and what's going on, right? So in this video, I'm going to unpack 2026 premium tax credits for those on an Affordable Care Act plan. And I'm also going to talk about ways to plan for that and how the One Big Beautiful Bill impacts that planning. So I think we have to step back, right? Before we think about 2026, we have to consider our history. There's history behind the premium tax credit. The premium tax credit started in the year 2014. And from 2014 through the year 2020, there were premium tax credit rules for ACA medical insurance plans. And there was, as part of those plans, a cliff. It said if your income exceeded 400% of the federal poverty level for your household, guess what? No premium tax credit, right? Depending on the situation, that could have cost thousands of dollars for having income at 401%, 405%, 410% of the federal poverty level, right? So that was a perilous, they call it the cliff. That's perilous. That's the first error of the premium tax credit. The second error of the premium tax credit we're currently in through 2025. 2021 through 2025, the rules changed. First, they increased premium tax credit amounts in a favorable way for those on ACA medical insurance plans. Second, and more important from an overall planning perspective, though, is the cliff went away. For those 5 years, they said, no cliff, just a gradual diminution in the premium tax credit as you had more and more income, which is only fair, to be fair, right? If you have more income, you should get less of a credit, basic principle. Okay. So right now we're in the second era of the premium tax credit. Starting in 2026, barring highly unexpected congressional action, we're going to go into a third era. Okay. The third era goes back to the first era in many ways, but it has one big improvement that I will talk about later in the video. So starting in 2026, we go into this third era that is not as good as the second era from a premium tax credit perspective, but is as good or better than the first era of the premium tax credit. And let's remember that even with the 400% of federal poverty level cliff, plenty of Americans got premium tax credits and plenty of Americans got to early retirement. That's instructive. Right, I've seen online a little bit of dooming about this topic, and I think that dooming is wrong and counterproductive. There's plenty of planning that can be done, and plenty of Americans can still get to their financial goals, whatever they may be, even in a world with the 400% of federal poverty level cliff on ACA medical insurance plans. Now let's go into some tactics that we can deploy to increase our chances of getting a premium tax credit and or increasing the amount of premium tax credit we get in 2026 and beyond. The first one is blocking and tackling, bread and butter. Most early retirees should mostly live off taxable assets first in early retirement. This can be a powerful tool to reduce income and then increase the amount of the premium tax credit. Say you're living on $100,000 in 2026. Well, you fund that by selling a few mutual funds. Well, what's your taxable income? We know your taxable income is not $100,000 because you have some tax basis in those mutual funds. Perhaps that basis is $40,000, $50,000, $60,000. Your taxable income might only be $40,000 or $50,000, even though you're living on $100,000. That obviously increases the chances you're going to get a premium tax credit. And we can do some other planning with those taxable accounts. One thing we might want to consider is turning off dividend reinvestment. Why would we do that? Well, we would direct those dividends into our brokerage account, into our cash account, right? From the brokerage to our checking account, say. Well, guess what that does? That takes that money and we can now live off of it. We don't have to trip capital gains on that amount later in the year, upping our income, reducing or eliminating our premium tax credit. So a little nickel dime planning there. So another thing is specific identification. right? Maybe an early retiree has a portfolio of, with ABC Mutual Fund, but it's bought at all different sorts of times. You can go into your financial institution's portal and specifically identify the shares that you're going to sell. And maybe you identify those shares that are lower, that have a higher basis, lower gain. So that could be another thing. We also want to think about just keeping our ordinary income low, generally speaking. So there are different tactics available here. One is don't claim Social Security early if you're looking to optimize for premium tax credit. Social Security creates income that reduces premium tax credits or could push you over that 400% of federal poverty level cliff. So that's one way to reduce our ordinary income. Another way is holding bonds in our tax deferred accounts, right? I'm not giving investment advice in this or any other video, but if you want to hold bonds and you happen to have an old traditional IRA, old traditional 401k, a great place to hide out that income on your tax return is just hold the bonds in the deferred account so it doesn't hit current year taxable income, potentially reducing or eliminating the 2026 premium tax credit. Another thing to think about is strategic withdrawals from Roth accounts, particularly Roth IRAs and health savings accounts. So there are ways what you could do is just recover your old annual contributions or properly seasoned old Roth conversions. You could take HSA distributions for old, what I call PUCME, previously unreimbursed qualified medical expenses. Those are tax-free ways to access your wealth to fund your living expenses, and they don't create income for premium tax credit purposes. So they can be valuable ways of managing your living expenses and funding your living expenses such that your living expenses aren't reducing the chance that you'll get a premium tax credit. And then another one, I'm going to be saying this all year long, bronze is gold. Remember that. Bronze is gold. So November 1st is 2026 annual enrollment for ACA plans. And I think some folks may want to consider switching to the bronze plan. So why do I say that? I say that because of a One Big Beautiful Bill change. One Big Beautiful Bill says starting in 2026, all bronze plans are going to be considered high deductible health plans. Okay, so now the bronze has two big advantages. One is it has lower premiums than a silver or gold or a platinum plan. So that's a big advantage, and that reduces the pressure on the premium tax credit. And remember, the premium tax credit is measured against the second lowest cost silver. So this can be a way to really reduce expenses. But then two, if you go with the bronze plan in 26 and beyond, you have access to a deductible contribution to an HSA. And this can set up a virtuous cycle in terms of reducing income that can help increase our premium tax credit. The way we do this is sign up for the bronze plan, lower premiums to start. Great. Then what you do, you fund the HSA, so you take a tax deduction for the HSA contribution. Also fantastic. Well, then a medical expense comes up during the year and you got a high deductible or it's otherwise not covered. You take the money right out of the HSA. So you don't go take it from a traditional IRA. You don't even go and take it from, say, a taxable brokerage with a small built-in gain. No. You take it from the HSA so you don't create taxable income to fund your medical expense for the year. It's a virtuous cycle. Deduct on the way in, no tax on the way out. We keep our income low, more of a premium tax credit. Bronze is gold. Generally speaking, you do you, of course. But I think a lot of folks are going to want to think about switching to bronze plans this fall when it comes to enrolling for 2026. Now, there's a couple other planning aspects out there. One, I call this COBRA planning. So you leave your job for an early retirement, you could have 18 months on COBRA. Now, you got to pay full freight. It's easier said than done. But, for some people, COBRA, which is 18 months of your old employer's plan where you're paying the entire cost plus a 2% administrative fee usually. But what that does is that can set up maybe a 12-month window where you don't have a premium tax credit issue to worry about. So maybe what you do, especially if that's in 2025, or maybe this is in the future and it's going to be your first year of retirement, maybe that's the year you do more Roth conversions, or even just take a taxable distribution from a traditional IRA or 401k and put it in your taxable account. You would do that generally if you're 59 and a half or older. The Roth conversion could work regardless of age. And what you could be doing there is setting up dry powder. You'd be setting up assets that you could potentially access in the future in a low tax or no tax way that could keep income down and help increase qualification for the premium tax credit. Essentially, you're using your 1 year where premium tax credit isn't all that relevant. Yeah, you're accelerating some taxes, but you're setting up dry powder so that you have low or no taxable income sources to fund living expenses in the premium tax credit relevant years. And 2025 too, right? So you might already be on an ACA medical insurance plan, and maybe your income's already low. You got to figure this through put this through the filter of your 2025 premium tax credit. But maybe your income's already low and you do some of that dry powder planning where you trip more Roth conversions, or you take some more money out of a traditional IRA if you're 59 and a half or older, put it into a taxable brokerage. Yeah, you pay some tax, but now you've got some dry powder that can, like I'm saying, support living expenses, tripping low or no capital gains. That could be an option as well. And then I'll mention it may be that some folks have cash in high interest savings accounts. Now, typically, as long as it's FDIC insured or got some sort of protection, you'd want to keep it there in many cases, but maybe you move it to a checking account that doesn't pay interest if you're a borderline case, right? That interest could be very corrosive if it just increases you from 399% to 401% of federal poverty level. Maybe it's worth not collecting some interest from the bank. Just something to consider. And then a last one to consider is people overemphasize the need for Roth conversions. And, few Americans need to feel bad about not doing Roth conversions, right? I think there's too much fear out there about RMDs, a widow's tax trap, and IRMA. I've talked about it on the channel before. And in fact, the one big beautiful bill, a lot of commentators are going to say it's going to spur Roth conversions. I think the opposite's probably true. That's going to be a later video. But for the time being, I think it suffices to say that for those on a ACA plan where income is very relevant for the premium tax credit, and especially that 400% cliff, you don't need to feel bad at all about foregoing a Roth conversion, right? They're oversold, they're overemphasized. I'm not here to say they can't work. And in fact, by the way, if you have no income, you very much might want to do a Roth conversion for premium tax credit purposes. But sometimes I see, I know I need to do a Roth conversion, which unless you have no income and aren't going to get the premium tax credit without the Roth conversion, almost certainly you don't need to do the Roth conversion. And this might be the era where those on a ACA medical insurance plan sort of put the Roth conversion in the drawer and don't touch it until Medicare enrollment. And I will mention there is a 1% chance that the foregoing was largely academic. Now, the foregoing matters even if they re-suspend the cliff, but I'm focused really on the 2026 issues and the concerns there. There's a 1% chance Congress before the year ends says, all right, we're going to renew that suspension of the cliff. I would not hold out that hope. And then I want to point out two resources I'm going to link to in the description below because there's a lot of fear-mongering around this topic. One is Internal Revenue Code Section 36B. It's a little dense, but why not actually read how is this computed? How is the premium tax credit computed? I think it's helpful to look at that. And then another one is KFF. They have a calculator for computing your ACA premiums and premium tax credit for 2025. It's a great little calculator, and it gives you, look, it's not been updated for 2026 yet, but at least it gives you a window in terms of the magnitude of this issue, and I think that's important. So I look at this as we're going into a new era of the premium tax credit. It's not as good as the previous era, but it's actually a little better than the first era from 2014 to 2020 because now all bronze plans are high deductible health plans, and anyone with a bronze ACA plan can make a deductible HSA contribution in 2026. That could be powerful for qualifying for the premium tax credit. What questions do you have about 2026 premium tax credits, ACA, this whole bit, one big beautiful bill? Let me know in the comments below. Thanks so much for watching. If you enjoyed this video, please mash that like button and subscribe to my channel. I will see you next time.